Hi there. So tax planning is unfortunately one of the most common things that people ask about, and so it makes sense to cover a couple quick things that I think are two of the most devastating and most common mistakes that people make, and it's basically failing to look at the data and plan on both the short term and the long term. The short term's a little easier, and a lot of people are aware of this. They just don't follow through. It's kind of like healthy eating. They know they're supposed to do it, but they don't always do it. The short term planning or near term tax planning is basically how you allocate your money now and how you do your reallocation of your portfolio, things like trades that you have to do and where you put your money. And that can have a huge impact on your performance, even more than your investments and certainly more than the investment fees that you pay. Because if you don't plan it right, you can completely erode a lot of your investment gains over time. It's sort of two steps forward, one step back. So that type of planning includes whether you have your money in a 401k plan or an IRA or some other tax deferred vehicle or even a tax free vehicle. There's not a lot of tax free vehicles, but there are a few things that are totally free of taxes. That means you never pay taxes while they're invested or while you take it out. Tax deferred, like a retirement account, means that you don't pay taxes while it grows, but then you take the taxes later. And there's different kinds of these things. There's Roth IRAs, different ways that it can be taxed or not taxed depending on your situation. You have different choices on that. But those are the general options that you have, kind of tax deferred, tax free, or taxable. Almost everything is taxable unless it's a rare case like a retirement account or a 401k plan, in which case it's tax deferred. And tax free is even more rare. Municipal bonds in your own state based on certain other criteria, and if you're not subject to alternative minimum tax, things like that might be tax free. There's certain weird tax credits and different investments like that that might be tax free. So that kind of planning, as I said, most people know about it, and it's something that you just need to be a little bit more aware of because the trades that you're doing day to day could have a huge impact on your performance of your portfolio over time. The second thing that people should be aware of, which I think is even less common and more neglected and maybe even more devastating, is for the long-term planning. And that basically is all about figuring out what your tax rate will be and planning for that in the future. So if I were to ask most people what you think your tax rate is going to be at retirement, a lot of people will say 30% or something like that. But in reality, if we look here at this chart, you see that the 30% is very rare. Very few periods in history where it's been sort of 30 or below 30. Brief period in the 20s and a couple other brief periods. Typically it's been more like 40 for recent history, but what's really relevant for this analysis is looking at long-term history. Your average long-term, and this is the top bracket, for time efficiency, and because it's the most dramatic, we picked the top bracket. But the top bracket has been as high as 94% for a couple of years in the 40s. It was over 90% for almost a decade, or just about a decade in the 50s, and 70% was sort of the norm after that. So when Ronald Reagan cut taxes in 1982, that was a really radical thing, and then they were cut further later. But that's not the norm. Historically, there's been a lot higher taxes. And if we look forward, going forward, we have this interesting, in the United States, we have this interesting phenomenon of the baby boom, where they've affected everything that they've touched from cradle to grave. When they were school age, we had to build a lot of new schools. When they were in their 20s and condos were hot, condos, you couldn't even pay to get on a waiting list for a condo. And then when they got into their 30s and moved out of the condos crashed like nothing we've ever seen before, and they moved into the suburbs, and the suburban houses went up, and now those are going down. So it's a constant cycle, and this goes across all kinds of purchasing, everything from cars, potato chips, all these other type of metrics that you can track. The baby boomers are a huge impact on the economy because they're such a huge generation. So now that they're pretty much leaving the workforce, baby boomers are in retirement age, they're pretty much starting to leave the workforce. They're not going to be paying into the system. So there's going to be less money coming in from them into the tax system. And there's going to be a lot more money coming out in the form of Medicare, Medicaid, Social Security, unfortunately welfare. And that's just the baby boomer issue. There's also the ongoing wars and overall spending and overall government expansion that we've seen under both Republicans and Democrats for quite a while. So, given those factors, given that the baby boomers aren't going to be putting in as much or anything into the system on average going forward, and they're going to be taking from the system in the form of Social Security, Medicaid, Medicare, welfare, and we don't see any end in sight for these never-ending wars, very expensive government projects, the increasing expansion of things like Department of Homeland Security, which now has 300,000 people, didn't have any people just a little more than a decade ago. Given all of these factors, it's certainly reasonable to plan your planning as if your tax rate is going to be around the historical average, which is quite a bit higher than it is now. Hopefully, taxes will be lower or the same, but they could very much go to the average, or they could even go to a point where it's above the average, and then you'd be seeing these 90% or 80% kind of ranges. So those are a few things that you really need to have. Have a near-term plan. Talk to your accountant about that, and work with your investment advisor. Work on the efficiency of your taxes for your portfolio, and then plan for that long term. And that's also something you can work with an advisor on. Plan for the long term so that your purchasing power will be preserved and that you'll have as much as you think you're going to have, and you won't get wrecked yet again by taxes in the long term. So it's a really important area. It's unfortunate a lot of people don't like to think about it, but taxes are a big driver to what your overall investment performance is going to be.